The best stock market investment guide ever, your guide to financial freedom in 2023. 2022 was a year of turbulence and extreme volatility in the stock market. Even though it felt like everything was going downhill, there's hope that financial markets can recover and provide positive returns for investors in 2023. For those of you looking to dive into the stock market and reap its benefits, we have created this comprehensive guide on how to make the best stock market investments that will set you up with financial freedom in 2023. Before you start investing, it's important to make sure you understand the basics. That means learning about what stocks are and how they work. In its simplest form, stocks are pieces of company ownership. When a company is listed on the stock market, it offers a certain number of stocks at a set price, usually determined by demand. By buying a stock, you become part owner of that particular business and stand to benefit from its success. When the value of a company increases, the value of its stocks go up too, meaning that you can potentially make a lot of money if your stock performs well. On the flip side, there's also risk involved, since stocks are subject to market fluctuations and other external factors. Let's say you invest in a company's stock and the value goes down. You can choose to hold on to your stock and wait for it to bounce back up, or you can sell it off, hopefully at a higher price than when you bought it. Besides simply buying and selling stocks, there are other activities you can do in the stock market. For example, you can use certain strategies to maximize your gains or hedge against losses. You can also trade derivatives such as options or futures contracts, which are bets on how the future value of stock will perform. These strategies require a bit more knowledge and experience than simply buying stocks, but they offer far more potential for profit and risk. Now that you know what stocks are, let's talk about why it might be a good idea to invest in them. First and foremost, because stocks are typically more volatile than other investments such as bonds or mutual funds, you can make money quickly if the stock does well. Of course, this also means that there's potential for quick losses, but with good strategy in place, these risks can be minimized. Next, investing in stocks also presents the potential for capital appreciation. This means that as the company's value increases, so too will the value of its stocks, and thus your investments. It's one of the most attractive features of investing in stocks, as it can produce long-term financial gains. Investing in stocks also provides you with some degree of control over your investments. While you won't be able to make every decision related to how a company performs, such as whether it should open up another branch for example, you can still decide when to buy and sell, which stocks to invest in, and so on. And after that, your understanding of what stocks are and why it makes sense to invest in them has probably improved. So let's look on to the next step: how to get started. Investing in stock as a beginner doesn't have to be complicated, just follow these steps. Step 1. Decide your goals. The first step is to decide what you want to accomplish through stock market investing. Most investors fall into one of two categories: those looking to make money in the short term and those looking to invest for long-term financial gain. If you're after quick profits, you'll need to do a lot of market research and focus on buying high-growth stocks. Keep in mind that these are often riskier investments and can lead to more losses than gains. This way you'll be less likely to suffer from market fluctuations and your investments can grow steadily over time. Other than your overall goals, you'll also want to decide on how much money you're willing to invest in each stock. Consider your budget, risk tolerance, and how long you plan on holding the stock before selling. You can also set an investment timeline so you know when to buy and sell. You're probably thinking, how much should I invest? Well, the amount you should invest in the stock market depends on a lot of factors, including your financial goals, risk tolerance, and timeline. It's important to remember that stocks can be volatile and there's always the potential for losses, no matter how experienced an investor you are. For young investors, it may make sense to invest more since they have the time on their side and can afford some potential losses. For older investors, however, it's usually best to be a bit more strategic and careful with investing, as you don't want to risk losing your hard-earned money before retirement. Remember, when it comes to investing in stocks, Only put in what you can afford to lose. Don't be tempted to invest beyond your means, no matter how enticing the potential returns may seem. Step 2. Choose an investment platform. Once you've determined your goals, it's time to choose the right investment platform. There are a variety of options available from companies like Fidelity, Vanguard, and Charles Schwab, so feel free to shop around for the one that best suits your needs. When selecting an investment platform, consider how much commission fees they charge, if there are any additional fees involved, and the types of stock or ETF, exchange traded funds, that you can purchase. Keep in mind that some platforms offer a wide range of stock options while others only provide access to specific markets, so make sure to research thoroughly. It's also important to remember that you won't be able to make any transactions without funds in your account, so ensure that you have enough money available before signing up with a platform. Ultimately, finding the right investment platform is about doing your homework and making sure it meets all of your needs and requirements. Make sure you take your time and compare the different platforms before deciding on one. Step 3. Select your stocks. Now that you've chosen an investment platform, it's time to start picking stocks. Before you do so, you should brush up on some basic stock market terms such as dividends, market capitalization, and price to earnings ratio. Knowing these terms will help you make informed decisions about which stocks to invest in. When selecting stocks, look for companies with a solid track record of financial performance and good prospects for growth. You may also want to research the company's management team and board of directors, as well as its industry landscape. Once you've identified some potential stocks, consider your budget and risk appetite when making the final decision. It's important to diversify your portfolio and not put all of your eggs in one basket. Step 4. Fund your account. As a beginner investor, the next step is to fund your account. Most platforms allow you to link a checking or savings account to your investment platform and transfer funds from there. You'll just need your bank account number and routing number information for this process. Most stock investing platforms have a minimum amount you need to invest, such as $100 or more. However, you can invest more if you choose to do so. Once the funds are in your account, you can start making investments. It's important to remember that investing carries some risk and should be done carefully with a long-term mindset. With the right knowledge and strategy, however, it can be a great way to grow your wealth over time. Step 5. Monitor your investments. Once you've funded your account and purchased stocks, the final step is to monitor your investments. You'll want to track the performance of each stock in your portfolio and make necessary adjustments as needed. Make sure to keep an eye on news and trends that could affect the stocks that you own. This will help you stay on top of the market and make more informed decisions. Additionally, it's important to regularly check your account and review your progress over time. Monitoring investments can be a tedious process, but is an essential part of a successful stock investing. With the right research and strategy, you'll be able to maximize your profits and build a strong portfolio. Step 6. Take advantage of tax benefits. One of the biggest advantages of investing in stocks is the potential to benefit from various tax breaks. For example, certain types of investments may be eligible for lower taxation rates or provide deductions that could save you money. It's important to research the type of investments you're making and the various tax benefits that come along with them. You may also want to consult a financial advisor or accountant for tailored advice on your individual situation. Some of the most common tax breaks for stock investors include capital gains treatment, qualified dividend income tax rates, and retirement accounts like 401ks or IRAs. Taking advantage of these tax benefits can help you save money and maximize your returns over time. Stock investing can be a great way to grow your wealth over time and take advantage of various tax benefits. Although it requires some research and understanding of the stock market, with the right knowledge and strategy, you can make informed decisions about which stocks to invest in. By following these 6 steps, you'll be well on your way towards becoming a successful stock investor. Start your research, fund your account, and make the right investments for you. Just remember to monitor your investments regularly and take advantage of tax benefits where possible. With the right strategy and dedication, stock investing can be an incredibly rewarding experience. Don't be afraid to take risks. With patience and research, you'll maximize your profits and build a strong portfolio in no time. Bear in mind though, don't put all your eggs into one basket. Good luck!